And this is what it comes down to. Many employers have no appreciation of how their plan is being paid for. Like, I can't tell you how many dozens, if not hundreds, of employers that I've talked to, literally at this point, over well into the hundreds. And I've yet to find a single one that can tell me how much they actually pay for their plan or how much their plan is paying for stuff. They just don't know. And what's weird is they do know how money gets into the plan. If they're contributing or they're doing a match, unequivocally, the employer is aware of that. Similarly, participants know how money's getting into the plan. It's coming out of their paycheck every payroll cycle, and it's going into the plan. What they don't understand is how the expenses are covered, and there are real expenses. So if the employer is paying those fees for the plan, administrative, investment advisor, audit, et cetera, they're fully aware of that. They're being invoiced or otherwise being, they have a receipt showing how much they paid. If it's coming out of the plan, then you also know, in a defined contribution plan, that's going to be either some sort of ERISA spending account where there's revenue recapture that's paying that, or it's actually being allocated directly to the participants. They'll see it on their statement. At the minimum, if there's a hard debit coming out of the plan, the trust statements will show this. It's going to be found on the audit 5500. These are pretty transparent. The problem that you run into is that's not how most of the small and mid-sized market actually pays for their plan. They typically pay via the investment offerings unknowingly. And that's not to say a particular investment strategy is good or bad. It's just that many are unaware of the multiple distribution share classes that may exist for a fund. So, for example, this is just the American Fund's 2030 Target Date Retirement Fund. This is not an endorsement of that fund. It's just one that was quick and easy for me to pull up. It is what it is. Looking at the share classes that you would commonly see in a retirement plan, this doesn't even include some of the other sort of non-retirement plan share classes. What you would find is the R6 share class has got an expense ratio of 35 bips or 0.35% annually. It shares nothing, meaning the cost of managing that fund is basically 35 basis points. That's debited out of the return for that particular fund or that share class and goes for management to cover the expenses. If you are instead in the R2 share class, it is managed by the same parties. It has the same holdings, basically identical, just has a different cost structure. It's 145 basis points, 110 basis points more expensive. Notice that the revenue sharing is 110 basis points. So what occurs is the participant's account is not debited 35 bips over the year. It's debited 145 bips. And once that 145 is received, 110 is earmarked to go to a third party. And that commonly goes to the record keeper, the administrator. It may be going to some sort of an investment financial professional, and maybe a combination of all of the above. And then it's being used to pay the expenses associated with running that plan. That in and of itself is not bad. And occasionally you'll see in funds that there's an arbitrage. So I've seen scenarios where the cost might have been 145, but it shared 125. And in that instance, the net cost is 10, not 35. So the real question is that a better deal than just paying 35? And my response is, who's getting the excess? It's coming back to the participant's account that there's a good argument that that's a better deal for that participant. But in a straight up scenario like this, the question becomes, why is that one participant paying, in two identical plans, why is one paying 145 and the other paying 35? And it comes down to the allocation of costs. And some of those costs associated with a plan are in fact a function of the asset level. Many are a function of headcount. So if you were to look at administration and record keeping, there are fixed costs associated with setting up and running a plan. It just is what it is. And as a result, if you have two participants, you're going to amortize that fixed cost over a small population of two. If you have 2,000 participants, that fixed cost is then amortized over 2,000 participants, 2 orders of magnitude larger, or 3 orders of magnitude larger. So as plan size grows in headcount, you'll find that the total cost goes up, but the per participant cost tends to go down. And that, somebody had a question, I think. So for that reason, it's important to understand what all of these expenses are, who's incurring them, how they're being incurred, for what services, et cetera.